Thank you very much for being with us right here. The breaking news is out on your screens right now at 5:30 p.m. We've got the CPI data at 5.18%, likely to have been at 5.45%, but of course this is lower than expected, and this is the low data that the street will cheer. Of course, internals are out as well, and we'll continue to get you more details. But Maithili, first up, headline figure at 5.18%, February CPI inflation, food inflation, and I was just catching on that data in just a bit. I will fill in my viewers right now. But Sajid Chinoy and Narendra join us as well. Maithili, your quick take then, 5.18% CPI for the month of February.
Well, it clearly ties in with what we saw of the WPI this morning, that inflation, low inflation is here to stay. The WPI has been negative for 16 consecutive months, and the CPI has come lower than what everybody had expected. Broad expectations were that it would be in the range of about 5.5, and this 5.18 number that we're getting is well below the number of 5.7 that we saw for the previous month. So clearly, as far as inflation is concerned, the battle has largely been won. It's not completely won. It's high time we focus now on growth and shift our focus just a little bit on inflation. Of course, in a country like India, you can never completely take your eye off inflation. But given what we'll be seeing on WPI as well as CPI, clearly now it is time, in fact we're a little late perhaps, to take our eye off inflation, now focus quite firmly on growth, particularly if you juxtapose this along with the IIP numbers we saw last week.
All right, I'll take it across to Sajid Chinoy there. And Sajid, do you agree with Maithili? And just before I hand it over to you, a quick look at the internals as well. Food is at 5.3%, rural inflation at 5.97%. Pulses have also climbed down considerably from 43.32 in the month of January to 38.3 as we talk right now. The focus should shift on growth and not inflation management really. But your quick take first on inflation, Sajid.
This clearly is a good number. I couldn't hear what Maithili said, but I think 2 points to make. One is that you have to look at where this is compared to the RBI's forecast. I think the RBI for the month of February is somewhere close to 5.4. So this gives you a little bit more breathing room. Secondly, I think this number doesn't fully capture the recent increase in oil and commodities. So what today's downside surprise does is buy some space and insurance going forward. So I think all told, this does pave the way for about 25 basis points of cut at the April review.
That's an important point indeed. Right at the beginning, I thought we were going to touch upon RBI action up next, but 25 basis points cut by the RBI. I wonder if my guests are being able to hear me, and can you please fix their audio? But Anand, if I may come to you, and Sajid is being as candid in the first 30 seconds that he had on the show, that this does pave the way for a 25 basis points rate cut by the RBI come the April policy. Will it be the inflation figure that is going to make Dr. Rajan decide what he eventually does, or is it actually going to be the fiscal deficit, which has been well maintained at 3.5% for next year, that is going to guide his policy action?
I think it's all the stars aligning, to be honest, and I tend to agree with Sajid. I think all the boxes have been ticked. The fiscal deficit has been kept by the government at a very creditable 3.5%. IIP continues to disappoint. Capacity utilization remains low. Credit offtake remains low. WPI, as Maithili mentioned, came off more than expected. And CPI has, we were expecting 5.5% to be the print. So 5.1, whatever, is clearly a huge positive surprise. I think all the stars are aligning, and we are now clearly looking for a rate cut between now and the actual policy date. I'm hoping that given the state of actual yields in the market, maybe there's room for more action than just a rate cut. Maybe some action on the liquidity front to address what seems to be a chronic problem on liquidity, which will remain at least for 2 weeks more. Maybe more space on the rate cut as well, maybe more than 25 basis points, going up to 50 basis points.
Sajid, because you started the whole debate on rate cut in the first 30 seconds of your answer, I must quickly get you to answer this question before I hand it over to Maithili. On the basis of this, you believe there can be a 25 basis points rate cut that is coming, but does the chance and the quantum of the rate cut not get higher with the government also meeting its fiscal deficit target? And like Anand pointed out very beautifully, all stars seem to be aligning at this moment, and Governor Rajan, do you think can oblige a little more than just 25 basis points?
So it's always possible. So I completely agree with Anand that the fiscal austerity or orthodoxy shown clearly will give the RBI much more comfort. It's important to note, however, that there are a few wrinkles here. The underlying fiscal stance is neutral if you take out asset sales, and state fiscal deficits will be widening this year as they are liable both for pay commissions and for interest on their bonds. So we need to look at the fiscal picture more holistically, and there you'll find either a neutral fiscal stance or a slightly widening one. But that, again, I don't want to quibble. I think the RBI will be very pleased that the government did the heavy lifting and stuck to its 3.5% number. I think they'll be pleased that today's print is below their glide path. Remember, they have a glide path that takes you to 5% by early next year, and I think the number you can impute for February was 5.4. So to the extent that this is 5.2, it's a little below RBI expectations. The only thing that I think will give policymakers pause is that you have seen some a rally in both oil and commodity prices in the last 3 or 4 weeks, and that may filter through into future inflation prints. So I think that could be one reason why the RBI is conservative and moves ahead with a 25 basis point cut now. You can never rule out the quantum. I don't want to second guess the central bank, but given that you're still above your medium-term inflation target, you'll want to see what the state of the monsoon is. Perhaps you do a little bit now and then you wait to see if more room opens up as you get closer and closer to your 5% inflation target, because right now, 10 months away, the bands of uncertainty are very wide. Remember last year at this point, when the RBI moved in 2 back-to-back cuts, they were running 200 basis points below their inflation target of 8% for that January. Now we're still a little bit above the 5% that we have to get. I think that could be one reason why you move a little bit now and leave open the potential and space to move a little bit later in the year when there is more comfort that you may be hitting your 5% target.
Oh, absolutely, and that's a very valid point that you're making. But Maithili, if I may just take this forward with you, and the point that Sajid made there, building on Anand's point of view, that it's all very good that the government has done the heavy lifting, and RBI is of course well on course as far as glide path of 5% inflation figure in January is concerned. But if you actually look at the state's fiscal deficit, it's likely to expand by 25 to 30 basis points next fiscal, and so the stance really there will be neutral fiscal stance. Do you believe that, coupled with the fact that oil, many people believe, have bottomed out, it's no longer sub 30, it's heading to levels of 40, do you believe that can be one of the things that will perhaps hold the RBI back in going the full hog like they could have?
Supriya, before I go to the state's fiscal deficit and the impact that has on the combined center and state fiscal deficit and oil prices, I think that's one thing that both Sajid and Anand seemed not to have, spoken of at all. They said all the stars are aligned, all the boxes are ticked. But what about the Janet Yellen box? The Fed is meeting on Tuesday and Wednesday, and it's going to, apparently it might take a decision to hike the interest rates, and somehow nobody seems to be talking about it at all right now. If you remember, not very long ago, every time the Fed was to have a meeting and the rate hike was expected, the markets would go hysterical. Is it that markets have assumed that she will not hike rates? What if she does hike rates? What does that mean for the boxes? Are they ticked? Are they unticked? If she hikes rates, where is the scope for us to cut? Of course, we've seen capital coming in again in the month of March, but remember the way the capital flew out of the country in the month of January and February. So I'm not very sure that, we should be worrying about fiscal deficit, about food inflation, oil prices, because what the Fed does has a huge impact on what any governor anywhere in the world does, particularly a governor of a bank like the Central Bank of India, the Reserve Bank, which is so critically dependent for its dollar flows. As far as FII flows are concerned, almost our entire inflows are, I wouldn't call it, well, I'm not perhaps, it feels a little uncharitable to call it fickle, hot money, etc. But there's no comparison, that it essentially is driven by arbitrage. So I wonder whether Sajid and Anand would share my view that you can't call the boxes all ticked until one knows what the Fed decides on Wednesday. Sajid, can I start with you and ask you, do you think that is something that we just seem to have overlooked at all?
Maithili, I think your question relates to the RBI's stance will be driven a lot by, or influenced a lot by, what the Fed does on Wednesday. Is that correct?
Absolutely, yes.
You're exactly right that we have to keep an eye on global factors and what the central bank does. But if you remember what the RBI said last year, that given this massive terms of trade shock from lower oil prices, the current account deficit and the balance of payments have reached a point of comfort, or there are enough buffers in place that monetary policy can begin to diverge from the center country. And not all emerging markets are in that state. A lot of emerging markets where debt flows dominate are constrained by following or being synchronous to where the US is. India might be in a slightly different position now because the current account deficit by our estimates next year is going to be sub 1% of GDP. India is on track to getting anywhere between $35 to $40 billion of foreign direct investment flows. And equity flows, remember, are often larger than debt flows. So while the interest rate differential will matter and will constrain the RBI from going on a large rate cutting cycle, I don't think it prevents the RBI from cutting rates by about 25 basis points, because we had the same scenario last September. The Fed was getting ready to move later that quarter, and the RBI still found the space to cut by 50 basis points. So I think modest cuts of 25 or 50 will not be unduly driven by global factors. There is space here, given what's happening on the external sector, for the central bank to respond to domestic growth and inflation dynamics. Beyond the point, of course, you are constrained by what's happening globally, but I don't think it affects the first 25 or 50 basis points of cuts.
Okay, now let me ask Anand that question. Anand, what made you omit the Fed action completely? And though I agree with Sajid that our current account deficit is not in a position where we really need to worry about it, should we not worry about the fact that the current account deficit is so low? Because in a developing country, we need to have a current account deficit closer to about 2.5% of GDP maybe, because that is the kind of money you need to draw in, because you need to fund your huge infrastructure investment. So a current account deficit that is very low, less than 1%, is not something to celebrate, just as a strengthening of the rupee is not something to celebrate. So two questions to you, Anand. A, why did you omit the Fed action completely? Is it completely irrelevant now? As Sajid says, does it not matter because RBI still has scope? And secondly, is a very low current account deficit something to celebrate? Just as a WPI, to my mind, 16 months of a negative WPI is not anything to celebrate. But maybe you disagree with me, Anand, as always.
No, Maitli, for a change, I agree with both you as well as with Sajid. I'll just add to the points, the very valid points which Sajid has already made. One is, look, the context has clearly changed from November, December of last year, where there have been serious doubts being raised about the quality of growth globally. We've seen a whole host of central banks turn turtle. We saw what the ECB did the last week. We expect the BOJ will expand and frankly do a lot more of loosening tomorrow. We expect the Fed to be on hold right now. So given the status of the global growth, even though there's been a bit of a risk-on sentiment coming back the last couple of weeks, we expect that everybody will take a deep breath and figure out what's really happening before the US Fed actually starts to mount on a Fed hiking cycle going forward. The other thing I would kind of add is, listen, yes, it's possible that given the inherent strength of the US economy, the fact that unemployment has come down, the fact that companies are sitting on cash, at some stage they could start to spend, it's always possible that the Fed will be the first to hike eventually, right? Having said that, one must remember that in absolute terms, 75 to 80% of global sovereign yields are below 2% today. There are sovereign yields like the BOJ, for instance, going at negative at the moment. There are plenty of them at far, far lower rates than where India is right now. Now, given that context, India at 7.6% for 10-year, the on-the-run security, or 7.75 for the off-the-run security, frankly, is just way too high. Now, we can quibble about whether it should be a 25 basis point rate hike or a 50 basis point rate cut. But I have no doubt in my mind that given the fact that our capacity utilization is this low, our credit offtake is this low, given the fact that the rupee has become stable again and frankly is still overvalued on a RER basis, given the entire global context and the outlook for CPI and for WPI, I think there's a strong case for the headline yields in India to come down from where they are. To add to all of our problems, we also have a stressed balance sheets of corporates. We have stressed balance sheet of banks. All this cries out for yields to come down from where they are, both on the government securities as well as on the actual rates to the real economy. Now, 7.75 on 10 years is way too high. Now, yes, we don't necessarily require 50 or 100 basis points of rate cut to bring these rate cuts, these rates down. We need transmission to improve. I think a critical portion of that transmission, which is hopefully something which RBI is looking at right now, is the liquidity paradigm. And even if we get 25 basis points of rate cut, but if the liquidity paradigm is relooked at to ensure that we don't have banks scrambling for 1.5 to 2 trillions of liquidity shortfall every day to cover for their CRR. If that's relooked at, and if we have a small surplus to start with, I can assure you
Anant,
that...
I'll have to hold you to hold on your thoughts there. I will have to ask you to hold on your thoughts there. We do have a reaction coming in from North Block on these numbers. Department of Economic Affairs Secretary Shaktikanta Das is speaking right now. All right, it seems we've lost that audio. Anant, you want to complete your point, and then I'll just get a quick closing comment from all of you. Anant?
So, just to close the point, Maithili, so therefore we are not ignoring what's happening globally, except that the global scenario has become far more benign than it was 3-4 months ago. Therefore, one doesn't really expect pressure to come from the global side. I think the reality is we need headline rates in India to come down, both on the government yield side as well as on the real economy side. Whatever it takes to bring it down, whether it's rate cuts, whether it's the liquidity paradigm, whether it's a combination of everything put together, getting clarity on the Uday scheme and the HTM there, etc., etc. Whatever needs to be done to bring down rates has to be done. I think the system is crying out loud for relief. Hopefully it will come through.
Fair point indeed. Hold your thoughts there. I'm now given to understand we do have the Department of Economic Affairs Secretary Shaktikanta Das with his quick reaction all the way from North Block on these inflation numbers. I'll take quick closing comments from both of you then.
Talk about you've got a good set of data coming out this time, significantly lower than expectations. First of all, your preliminary comments.
Now the inflation numbers which have come out today, the CPI particularly, it is on expected lines, and 5.2%, which is on expected lines, and it is mainly caused by the fact that food inflation has come down. And the main component within food inflation which has come down is with regard to vegetables. So on the whole, in a single sentence, I would like to say that the numbers are on expected lines.
Right. On that front, sir, obviously it's an obvious question to ask, but is that now does that now give significant impetus to monetary easing, or is this more of a blip in the radar?
No, I would not like to sort of prejudge the issue whether it's a blip in the radar, but with regard to the monetary policy stance, it's for the Reserve Bank to take a call. Right, so you have to wait for that. Thank you.
Thank you.
All right, that's Shaktikanta Das with his quick reaction on expected lines data and monetary policies, of course, an action that people on Mint Street will take. But closing comments very quickly, Sajid, and if I may come to you, where do these numbers indicate the average CPI for this year is going to be? Safe to assume at about 5%, because the outlier in this data is really vegetable inflation, and that is now at 0.7 of a percentage point versus nearly 6.4% in the previous period.
So the big downside surprise is vegetables, both in the WPI and the CPI. As I said, what this does is, our forecast is still, 5 or just below 5 for the end of the year, which is close to the inflation target. What this does is it buys you some space and insurance to offset what could be price pressures arising from the mean reversion of oil and commodities seen in the last 2-3 weeks, which will show up in the March and April inflation prints. So ordinarily, that may have put upward pressure on the CPI trajectory compared to what all of us believed 2 months ago. I think what today's downward surprise led by food does is balance those risks out. So we're still looking at inflation gradually settling in the low 5s in the second half of the year and moving towards 5%. I think what all of that means is there is modest space for monetary easing, but not the kind of space that you saw in 2015, where you were running a couple of 100 basis points below your inflation target and the RBI was able to cut rates. But on the whole, a very good number, and I think we're seeing an increasingly good policy mix where fiscal policy is getting tighter, and that's allowing some space for monetary easing.
So the thumbs up coming in from Sajid Chinoy as far as the two sides of the policy is concerned, both fiscal and monetary. I'm afraid completely out of time on this edition of the special show, but we've got to take a quick breather. We come back with hot commodities as follows right next. Thank you very much, Sajid, Anant and Maithili, for being with us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.